Global stocks begin the week near record highs, with all eyes on US inflation figures for confirmation the Fed can ease this year. China's economy is showing early signs of recovery, and New Zealand manufacturing is still contracting, but at a slower rate. That's coming up in our 5 Things in 5 Minutes. And then, in our bonus deep dive interview, ANZ Australia's Head of Economics, Adam Boyton, previews Australia's federal budget, which is due on Tuesday night.
The more we look into the future, the more things like demographics, ageing of the population, increases in the size of a number of key government programs, that does make it harder to sustain surpluses through the future.
But first, in 5 and 5 with ANZ, global markets begin the week in a positive mood, with US stocks back near their record highs and bond yields indicating investors are still hopeful the Fed can cut rates by the end of the year. Investors pushed European stocks to fresh record highs on Friday night, with expectations almost fully baked in that the European Central Bank can start cutting next month. The US dollar nudged higher over the weekend. That saw the Aussie and Kiwi dollars drop around about 0.2%. They start the trading week at 5 a.m. Sydney-Melbourne time at 66.03 US cents and 60.19 US cents, respectively. Stocks also surged in China on Friday night, and there was positive inflation data over the weekend amid signs foreign investors may be returning. Here's ANZ Group Chief Economist Richard Yetzinger.
We've had 3 inflation surprises in a row, not enough to really change the macro dynamic, but just a hint that there might be something else going on. The equity market, of course, in China has been doing quite well. What's been missing is the activity side of the economy. We are expecting in this week's numbers retail sales and industrial production to be a bit better. We at least need to see some stabilisation to keep the idea alive that China has a good chance of hitting its 5% growth target this year.
Number 2, the main data to watch in Australia this week is from the labour market, with March quarter wages due on Wednesday and unemployment figures on Thursday. Here's Richard.
Some decline in wage growth is probably going to be required to sustainably hit the centre of the Reserve Bank's target band at 2.5%. And we had, if you go back a few months, Australia had a couple of weak labour market outcomes. Easing expectations were brought forward. We've had a couple of strong labour market outcomes. Easing expectations were pushed out. Our expectation is this reading will again go back to that soft kind of reading and should probably encourage the market to bring forward its rate cut expectations again.
Number 3, the other big data to watch this week is US inflation data on Wednesday night.
Last month's US inflation numbers really put the nail in the coffin of the July rate cut idea from the Fed. So this number unquestionably is important, has the potential to go further to cement expectations about when the Fed will move.
Number 4, we got inflation data out of China over the weekend. CPI inflation was 0.3% in the year to April. That was slightly higher than expected and up from 0.1% in March. Producer prices fell 2.5%, a larger drop than expected, but still an improvement on March. ANZ senior China strategist Zhao Pengjing says the industrial sector remains in deflation due to insufficient demand.
Looking forward, we expect policymakers will place emphasis on price recovery. More stimulus can be expected to boost the demand side. The Q1 monetary policy report released on last Friday indicated a triple cut to come soon in Q2. We also expect another policy rate cut in Q3.
Number 5. New Zealand's economy is still subdued, with performance of manufacturing index data on Friday showing the manufacturing sector still contracting in April, albeit at a slower rate than in March. Here's ANZ senior economist Miles Workman.
So the PMI, just for context, has been in contractionary territory for more than a year now, but there is tentative evidence that the floor is approaching, with the details showing production, output and employment were actually expansionary in the month of April.
Miles Workman there. Now, in our bonus deep dive interview, ANZ Head of Australian Economics Adam Boyton is watching the size of any stimulus in Australia's federal budget due on Tuesday night around 7:30 p.m. Canberra time, and whether the RBA can still ease later this year.
There are usually a few things that are your go-tos in the budget. Look, the first is just what is the budget position, deficit, surplus, how big, how small. And there I expect we will end up with a small surplus for the financial year that's just about to end. So that's 2023-24, surplus there of $4.5 billion. And then I think we move into deficit in the following year. So that's 2024-25. To the tune of $15.25 billion. The second thing is how much new spending in net terms is there in the budget. So the budget always has some savings measures, new spending initiatives. As a macroeconomist, what I'm interested in is what's the net of those two. And here we're expecting the budget to contain net new spending of around $10 billion in 2024-25. That's around, I should say, 1/3 of a percentage point of GDP, and that's been our expectation for some time. And then I think the third thing you should always look for in a budget is what are the new measures that government is funding or announcing in that budget. And here, often you get these pre-flagged, I guess, in press reports. Here, I think we'll get an extension of cost of living relief measures. The government's already announced changes to the indexation of student debt. And I wouldn't be surprised to see some additional funding for the future Made in Australia package.
So if we do get that $10 billion in net new spending, which represents about 1/3% of GDP, what might that do, if anything, to the outlook for the Reserve Bank of Australia and whether it has to react or ignore that stimulus?
We've been expecting the budget to have net new spending of that amount for quite some time. So this is already baked into our economic forecast. So if we get something between 1/4 and 0.5% of GDP in net new spending for this coming financial year, 2024-25, there's no impact on our expectations for growth, inflation, or the RBA. I think what's probably just as important, if not more important, is getting a sense of how consumers respond to the Stage 3 tax cuts, which come into effect on the 1st of July. And there, I think, looking at high-frequency consumer confidence measures like the weekly ANZ Roy Morgan Index will give us a sense as we move past the budget into July and through into August, how much of these tax cuts are consumers spending versus how much are they saving. Now, if they save more than we think, it's quite possible that growth this year could be a little bit lower than we were expecting.
Just for our international audience who may be surprised to hear that there is a government that has some money to spend and that actually has a surplus in the last year or two, why is that? Why is Australia so much better off in terms of its underlying budget position than some other countries, not just on the deficit surplus front, but also on the debt front?
Probably the main reason for that is the Australian federal budget has benefited enormously from very high commodity prices. And indeed, part of the reason why the budget is forecast to move back into deficit is the Treasury Department typically adopt a fairly conservative approach to forecasting commodity prices, which means that often over the medium term, the deterioration in the fiscal position that they sort of bake into the numbers to take into account the possibility that commodity prices may revert back to normal, more, I guess, long-run normal levels or long-run historically average levels. When that doesn't come through, that tends to support the fiscal position. But I guess what I'd also say is if I look at the medium-term budget figuring, it does suggest that the couple of surpluses we've seen, the more we look into the future, the more things like demographics, ageing of the population, increases in the size of a number of key government programs, that does make it harder to sustain surpluses through the future.
Adam Boyton there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, May the 13th. Catch you tomorrow with an in-depth look into the state of China's property market. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.